You did everything right. So why is retirement so tax complicated? Success creates complexity. If retirement feels more complicated than you expected, you're not alone, and you're not doing anything wrong. In fact, the reason retirement taxes feel so confusing is often because you did everything right. You saved consistently, you used tax-advantaged accounts, you invested prudently, and you earned well. And now, instead of simplicity, you're staring at a web of tax rules, income thresholds, Medicare surcharges, withdrawal decisions, and planning trade-offs that feel anything but straightforward. This isn't a failure of planning, it's the natural outcome of success. Today, we're going to unpack why retirement becomes tax complicated for people who did things correctly, why retirement planning stops being linear, why the transition from saver to spender changes everything, and why optimization, not rules of thumb, become the only viable approach. And these roadblocks are different at different levels of wealth, so there is no one-size-fits-all solution for everyone further complicating matters. Before we dive into all that, my name is Ryan Knoll, and I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm where my team and I help clients nationwide make smart money decisions. Let's get started. There is a myth of the simple retirement. Many people enter retirement expecting things to get easier. There's no paycheck, lower income, lower taxes, and fewer decisions. That's rarely how it works though, especially for disciplined savers. If you spent 30 or 40 years doing the right things, you probably arrive at retirement with multiple retirement accounts, a taxable brokerage account, Social Security benefits, required minimum distributions looming, maybe a pension or deferred compensation, and Medicare and healthcare decisions layered on top. Each of these pieces has its own tax rules, and the complication doesn't come from any single item. It comes from how they all interact together. First, there are multiple accounts, which means multiple tax systems. One of the biggest sources of retirement tax complexity is account diversity, which ironically is just the result of good planning. A typical successful retiree may have traditional IRAs or 401ks, which are tax deferred, Roth accounts, which are tax-free, taxable brokerage accounts, cash and fixed income, and Social Security income. And each bucket is taxed differently. IRA withdrawals are ordinary income, Roth withdrawals may be tax-free, or brokerage withdrawals are part taxable and part tax-free, and Social Security may be partially taxable, and capital gains have all their own tax brackets together. There is no universal best withdrawal order, because the tax outcome depends on how much you take, when you take it, and what else is happening that year. This is where retirement stops being arithmetic and becomes sequencing. Then there is income layering, which creates tax stacking. While working, your income came from one source, likely just your paycheck. In retirement, income comes from layers. A single retirement year might include things like Social Security, IRA withdrawals, capital gains, dividends and interest, Roth conversions, required distributions, and one-time events like selling a property or business. Each layer stacks on top of the others, and that's where the surprises occur. One extra withdrawal can push Social Security into taxation, trigger Medicare IRMAA surcharges, move you into a higher marginal bracket, increase capital gains taxes, and reduce deductions or credits. That's why retirees often say, I took out $10,000 and it cost me far more than I expected. The tax code isn't punishing you. It's reacting to stacked income and how that interplays with all the other different parts of your plan. And this is why retirement planning isn't linear. During your working years, planning was linear. You earn more, you save more, invest more, lather, rinse, repeat. Retirement planning is not linear, it's interactive. Every decision affects multiple outcomes. Withdrawals affect taxes, taxes affect Medicare premiums affect cash flow affects portfolio withdrawals, and portfolio withdrawals affect future taxes, further continuing the cycle. There's no straight line from decision to outcome. Everything loops back on itself. That's why rules of thumb fail in retirement. They assume linear cause and effect. And retirement simply doesn't work that way. It's a series of binary or multivariate inputs that create more complex outputs. Let's first talk about the saver to spender transition. One of the most underestimated shifts in retirement is psychological. The transition from being a saver your whole life to now being a spender of your assets. For decades, your job was accumulation. You were rewarded for restraint. Taxes were something you minimized instinctively. In retirement, the objective flips. The goal is efficient spending, not maximum saving. But old habits linger. There's fear of withdrawing too much, aversion to paying taxes even when strategically beneficial, and over-conservatism that sacrifices long-term flexibility. Many retirees hesitate to do Roth conversions because they don't want to pay tax, or just spend from their IRAs altogether because they want to save them for later, or they don't use their taxable assets strategically. This hesitation often increases future taxes rather than reducing them. Paying some tax intentionally at the right time can reduce total lifetime taxes, but that requires a mindset shift and a plan. And that's what's most important, reducing lifetime taxes. So many people we meet want a silver bullet strategy that reduces tax in a given year, but then only defers an even bigger tax liabilities a few years down the line. There's no one solution that solves the retirement tax issue. Anyone who tells you otherwise is just trying to sell you something that they likely do not even fully understand themselves. This is why success creates more tax layers, not fewer. The more successful you were, the more planning layers exist. Higher balances create larger RMDs. Larger RMDs create higher Medicare premiums. Higher income affects Social Security taxation. Bigger portfolios create capital gains considerations. And more assets create beneficiary tax issues. None of this is punishment. It's simply the system responding to success. But it means that retirement planning becomes about coordination, not avoidance. Then there's the illusion of that we're always going to pay lower taxes in retirement. Many people assume taxes automatically fall once they stop working. Sometimes they do. Often, though, they don't. Reasons taxes stay high or rise include RMDs forcing income later in life, Social Security stacking on top of withdrawals, loss of deductions, capital gains realization, Medicare premium surcharges, and inherited IRA rules affecting family planning. This is why the most valuable tax planning often happens in your 60s before RMDs and full Social Security income lock in your baseline. Before we talk about how to optimize your retirement, I want to thank you for taking some time today to watch our video. We strive to make this channel a place where you can learn and engage to help you make sound decisions on your retirement journey. We have some great content coming out this month, and to make sure you don't miss it, you'll want to subscribe to the channel. Now let's talk about the optimization strategies. So why does optimization replace rules of thumb? Rules of thumb exist because they're easy to explain. They break down because they ignore interaction effects. Examples of some rules of thumbs are spending your taxable assets first, delaying Social Security to 70, converting as much to Roth as possible, or keep a 60-40 portfolio. Each of these can be right or wrong depending on what your tax brackets are, your account mix, your health and longevity, your spouse's situation, your estate goals, and your Medicare exposure. At this stage, planning becomes optimization. Not the lowest tax this year, not the highest return, but the best trade-off over time. Optimization accepts that you can't win on every metric simultaneously, but you want to be clear about where you are winning because that's how you enhance your returns. But you could also do nothing, which often makes things worse. When retirement feels complex, many people freeze. They default to taking their minimum distributions, avoiding conversions, letting accounts grow untouched, and reacting year by year. Unfortunately, this passive approach often leads to higher future RMDs, lost Roth conversion windows, increased Medicare premiums, and less flexibility later. In retirement, inaction is still a decision and often an expensive one. Optimizing for just one of those variables can save you tens of thousands of dollars. Optimizing for the right one can save you hundreds of thousands. Let's go over a practical example. Consider a couple who saved diligently, built a $2.5 million portfolio across accounts. They retire at 65. Without coordination, they delay planning, RMDs spike income in their 70s, Social Security becomes heavily taxed, Medicare premiums rise, and heirs inherit large taxable accounts. With coordinated planning, they use early retirement years to smooth income, perform measured Roth conversions, control future RMDs, maintain stable Medicare costs, and improve after-tax outcomes for their heirs. Same discipline, same savings, completely different result. But if you wanted to follow that same example as a single person or with someone who had a bit less saved, it's probably not the optimal approach. Just for fun, let's take a look at a single retiree who has $1.2 million saved. Half is in brokerage accounts with a basis of $400,000, and the other half is in pre-tax IRAs. They're 62 and weighing when to take Social Security, and how RMDs will potentially impact IRMA down the line. They also need about $6,000 a month to live on, and Social Security currently is $2,000 a month. But if they wait till their full retirement age at 67, it's worth nearly $3,000. For this client, it would make sense to fund spending from their IRA. They would need to pull roughly $79,000 this year from the account and pay roughly $7,000 in federal taxes to meet their spending needs. You would also want to factor in state tax into this, but for simplicity, let's just assume they live in a no income tax state. If they followed that process, then they would have reduced their retirement balance to about $360,000 at full retirement age and would then start receiving Social Security benefits of $36,000 or half of their spending needs pre-tax at that same point. They would have to supplement with withdrawals from the portfolio of roughly $40,000 to continue to meet their needs moving forward. But even that is likely inefficient in this situation. This same person might want to consider Roth conversions. They would deplete the account around full retirement age if they converted up to the 22% bracket. Social Security at this point would still be 85% taxable, but they could realize $16,400 of capital gains and not have to pay any income tax on that gain realization. What that means is if they freed up an additional $36,000 of post-tax income from those gains, they would only pay tax on the 85% of their Social Security benefit, which is roughly $4,000 annually. Using strategies like tax loss harvesting and direct indexing can make this a reality with their brokerage account, but planning needs to start well before they get to that point. That just goes to show you how people at different levels of wealth and different marital statuses need to approach planning completely differently, or the outcome won't be optimal for them. So what's the real goal behind retirement tax planning? The goal is not simplicity. The goal is clarity. Clarity about where income will come from, how much tax is intentional versus accidental, which levers you can still pull, which decisions are permanent, and how today's choices affect future flexibility. When retirees understand the system, complexity becomes manageable. The bottom line here is if retirement taxes feel complicated, it's not because you failed, it's because you've succeeded. Success creates multiple accounts, multiple income sources, and multiple tax layers. Retirement planning stops being linear and starts being interactive. Rules of thumb give way to optimization, avoidance gives way to coordination, and saving gives way to strategic spending. The retirees who thrive aren't the ones with the simplest situations. They're the ones who understand the complexity and plan within it. If you want help untangling retirement tax complexity and turning it into a coordinated strategy, that's exactly what my team does here at Nav Wealth Partners. Thank you for watching, and as always, make smart money decisions.